The income statement, also known as the profit and loss statement, is one of the core financial statements that provide a comprehensive summary of a company's financial performance over a specific period. It serves multiple purposes, offering insights into various aspects of the business that are crucial for stakeholders, including management, investors, and creditors. Main purposes are as follows. Evaluate profitability. The income statement's primary function is to evaluate the profitability of a business. By detailing the revenues generated and the expenses incurred, it shows whether a company is making a profit or a loss. Profitability is assessed by subtracting total expenses from total revenues. If revenues exceed expenses, the company is profitable. If not, it incurs a loss. This assessment helps stakeholders understand how effectively the company converts its activities into profit, which is vital for long-term sustainability. Understand revenue streams. Another critical purpose of the income statement is to break down the company's revenue streams. It shows where the money is coming from, whether it's from the core operations of the business, such as sales of goods and services, or from other sources like investments or the sale of assets. By analyzing these revenue streams, stakeholders can determine which aspects of the business are the most lucrative and which may require strategic adjustments. For instance, a company might identify that a particular product line is underperforming and decide to allocate resources differently. Expense management. The income statement also provides a detailed view of the company's expenses, which is essential for effective expense management. It categorizes expenses into various types, such as cost of goods sold, COGS, operating expenses, and non-operating expenses. By analyzing these expenses, management can identify areas where costs may be reduced or managed more efficiently. This understanding can lead to improved profitability by controlling overheads and optimizing resource allocation. For example, if a company finds that its operating expenses are too high relative to its revenue, it might look for ways to cut costs, such as negotiating better terms with suppliers or reducing energy consumption. Assess operational efficiency. The income statement allows stakeholders to assess the company's operational efficiency. This is done by comparing revenues with expenses and analyzing the relationship between the two. If a company is generating high revenue but also incurring high expenses, it may indicate inefficiencies in operations. Conversely, a company with moderate revenue but low expenses might be operating efficiently. Operational efficiency is crucial because it affects the company's ability to compete in the market. A more efficient company can offer competitive prices, invest in innovation, and achieve higher profitability. Predict future performance. The income statement can also be used to predict future performance. By analyzing past trends in revenues and expenses, stakeholders can forecast the company's future financial performance. This is particularly useful for investors who need to make informed decisions about whether to buy, hold, or sell their shares in the company. For example, if a company has consistently increased its revenue while maintaining stable expenses, it may be seen as having strong growth potential. On the other hand, if expenses are rising faster than revenues, it could signal potential trouble ahead. Evaluate the impact of one-time events. Sometimes, a company may experience one-time events that significantly impact its income statement, such as the sale of a major asset or restructuring costs. The income statement helps stakeholders evaluate the impact of these events on the company's overall financial performance. By distinguishing between regular operating income and these unusual or infrequent items, the income statement provides a clearer picture of the company's ongoing profitability. This distinction is crucial for understanding whether the company's performance is sustainable or if it's influenced by temporary factors. Compliance and regulatory reporting. The income statement also plays a crucial role in compliance and regulatory reporting. Companies are often required by law to produce income statements as part of their financial disclosures. This ensures transparency and provides regulators, tax authorities, and other external stakeholders with accurate information about the company's financial health. For public companies, this is particularly important as it affects stock market performance and investor confidence. Accurate and compliant income statements also help avoid legal issues and penalties that could arise from misreporting financial information. Investor and creditor analysis. Investors and creditors use the income statement to assess the company's financial viability. Investors look at the income statement to determine whether the company is generating enough profit to justify their investment. They may focus on metrics like net income or earnings per share, which are derived from the income statement. Creditors, on the other hand, are interested in whether the company has enough income to cover its debt obligations. A strong income statement suggests that the company can meet its financial commitments, making it a safer bet for lending. Benchmarking against industry standards. The income statement also allows companies to benchmark their performance against industry standards. By comparing key figures such as gross profit, operating income, and net profit with those of competitors, a company can identify areas where it excels or lags behind. This benchmarking process is vital for strategic planning and decision-making, as it helps companies understand their competitive position in the market. For example, if a company's gross profit margin is lower than the industry average, it might need to review its pricing strategy or reduce production costs to improve profitability. Supporting strategic decisions. The income statement supports strategic decision-making within the company. By providing detailed insights into revenues, expenses, and profitability, it helps management make informed decisions about the direction of the business. This could involve decisions about expanding into new markets, launching new products, or restructuring the organization. For instance, if the income statement shows strong profitability in a particular market segment, the company might decide to invest more heavily in that area. Conversely, if a product line is consistently unprofitable, the company might choose to discontinue it or find ways to turn it around. Key takeaways. The income statement is a vital financial document that serves multiple purposes, from evaluating profitability and understanding revenue streams to managing expenses and supporting strategic decisions. It offers a detailed overview of a company's financial performance, helping stakeholders make informed decisions. By analyzing the income statement, stakeholders can assess operational efficiency, predict future performance, and ensure compliance with regulatory requirements. Ultimately, the income statement is a powerful tool for understanding a company's financial health and guiding its future growth.